So debt is a really interesting little beast. There are methods to make it easier for you to reduce your debt load. And as you reduce your debt load, not only will it improve your credit score, especially if you're talking about credit card utilization, it's also going to give you sort of this lightness of heart, which I think you would appreciate. And there's two different ways that we're going to talk about debt reduction. I'm going to show you a video right now that does that. And one of them is sort of like the math, and one of them is the sort of makes you feel better faster. The thing is that each one of those, the difference in how you actually pay off your debt.
I just decided.
All right, so let me get this.
Is the difference between the debt avalanche and the debt snowball debt repayment? Well, the debt avalanche method is basically when you focus on your debt that has the highest interest rate and you focus on paying off that debt first. While on the other hand, the snowball method is where you focus on the debt that has the smallest balance and you focus on paying off that debt first. And then you take that extra money from paying off that first debt and you roll it into your next smallest balance, and thereby building a snowball effect with your debt repayment. With both of these approaches, you essentially need to create a priority list of your debt. So with the debt avalanche method, you're going to list out all of your debts and organize them by highest interest rate to lowest interest rate. And with the snowball method, you're going to again list out all of your debts and organize them by balance, from smallest balance to highest balance. And that's the priority as to which you're going to pay off your debt. And the way you actually pay off your debt using either of these methods is that you focus on paying as much money as you can afford, more than the minimum payment, to your priority number one debt, while paying the minimum payments to all your other debts. And by paying more than the minimum to your priority one debt, you're able to get ahead of the compounding interest and pay this debt off quickly. And then once that debt is paid, you take all that money that you're putting towards that priority one debt and you put it to your next top priority debt. With the avalanche method, as you go through the different priorities of your debt, you will find that the debt that you're paying has lower and lower interest rates based on how you prioritize your debt. And with the snowball method, you'll find that as you go along with your debt repayment process, the debt that you're paying becomes larger and larger. However, this is based on the priority that you have set to focus on paying off your debt that has the smallest balance first. So which of these methods make sense for you? Avalanche versus snowball? Well, the answer is that it really depends. If your focus is to really save as much money as possible on interest payments as you work towards debt freedom, then the debt avalanche method might be the one for you, because when you focus on paying off the debt that has the highest interest rate, you're essentially minimizing the impact of compounding on your debt as you work on paying down that debt, because you're tackling that highest interest rate first, right? However, if you're someone who thrives on quick wins and you want to see quick progress be made as you pay off balances, then focusing on the debt that has the smallest balance, that is the snowball method, can be more beneficial or more your style. Whichever one of these methods you use, they both work and they are both effective with paying off your debt. The key is prioritizing your debt, paying more than the minimum payment on your top priority debt, and staying consistent with your plan, and you will definitely see the results. So are you in the process of paying off debt, and which of these methods have you found is working for you? Have you even tried either one of them? I would love to know. Please share in the comments.
All right. So part of me thinks, because I've heard that several times, that I understand what it's saying. What I'm wondering is, just a show of hands, y'all are not giving me cameras today, so I have no idea what facial expressions are like right now. I just want to get an idea. Was that understandable, exactly how that method works? Yes, no, give me maybe a Y in the chat so I can get it.
Got some yeses in the chat.
Okay, good. I have used the, I personally prefer the avalanche method just because I want it to go faster and I want to save more money. But I know people that have used the snowball debt reduction. And the thing that's nice about it is you can go to the internet, type in calculator, and it will literally give you exactly how much you have to pay on each for each month for each of your credit cards. The important part is that while you're in this process of paying off debt, that you don't get in more debt. So your goal is to get those credit cards paid off. And if you're adding more to the credit cards, then it kind of throws everything, like it's harder to get the debt actually reduced at that time. The other piece that I want to give you guys is, yet last week we talked about your credit report. Many of you did pull your credit report. Probably the biggest pain for figuring out the debt avalanche or debt snowball is to figure out exactly how much you owe for each of your credit cards or for your car payment or whatever loans you might have. If you actually go to your credit report, it is the easiest way to like list off all the different debts that you have. Sometimes you're going to see interest rates, but often you won't. To get the interest rate for your credit card, you'll mostly have to go to your credit card statement, which sometimes are online and sometimes people still get paper. I haven't gotten paper in a really long time. Okay. I want to talk a little bit about student loans. So student loans, okay, have gotten a little bit more complicated. During COVID, everything was kind of put on hold for a little bit. And now it's back. Now you have to pay your student loans. Those student loans do not ever come off your credit report. You must pay them. If you default on your student loans, you will go to collections. And if you do not make a deal to actually pay off those student loans through collections, they're going to garnish your wages. They're going to take away any, if you have any tax rebates that are coming in, refunds that are coming in. And they'll also garnish your Social Security. So let's say you go 30 years and you still haven't paid off your student loans, they will actually start to take it from your Social Security as well. So what I want to say about student loans is, if you are not yet in a repayment process, please get into a repayment schedule. If you do not currently make enough money to pay off your debts, get into an income-driven or income-based repayment. Here's the thing about the income-based repayment. If you have an income-based repayment that says you don't have to pay anything because your income is so low that we're just going to have you not pay anything, your debt still gets bigger. There's still interest that is being accrued on those debts. But here's the key piece. If they're telling you that you have 0% or zero money for your monthly payment, don't pay anything. Because if you do, they're going to revisit your payment and they're going to expect you to be able to do that all the time. The other piece, though, which is like the opposite of what I just said, is if you do have student loan debt and you're trying to figure out how to make it go away faster, either going to bi-monthly payments where you make payments twice a month, or if you put a little bit more on and ask them to put it towards the principal, that's actually going to reduce your student loans faster. The other thing I wanted to point out is that in the last couple of months, we've probably heard the Department of Education is the actual student payment repayment process is being moved from the Department of Education to the Treasury. And that's going to impact the process. So just be aware that there may be hiccups that happen while you're in your process, especially if you happen to be right now at that time where you are reassessing how much money you're supposed to pay. If you are in an income-based repayment plan, you do need to up that every single year. You need to prove that you still need to be in that debt repayment program. A lot of the programs still exist, but these programs are, with the Trump administration, they're making it more difficult. And they're probably going to be increasing the amount of money that they expect people to be paying that are income-driven repayment plan folks. Okay. Are there questions on student loan debt? Any issues you guys have had with student loan debt? If you have ever defaulted on your student loan or if you are in collections, there are tricks to getting it off your credit report. The major trick is if you actually consolidate all your student loans, you're allowed to do this one time in your life. Say you're in collection, you consolidate them, they take them out of collection. Little known fact. It's a super, super easy process to do. You can also rehab your student loan if your student loan has gone into default. So if that happens, the place that I would go is there's these people called HUD housing counselors. It sounds crazy, but they're trying to get people ready to buy houses. And they are very, very good at figuring out your best step forward for your student loans. I'm wondering just one question. Are any of you working towards a forgiveness? Like, do you work for a nonprofit organization or a government agency? When I first started working on people's oh, good, Mignona. I was hoping you would say that. When I first started working on this, like I knew one person that had ever received the forgiveness. And now it's actually relatively common. Um, uh, yeah. So just make sure if you do that, that you actually go through the process. Anyway, keep your ears and eyes open for what's going on with the Trump administration, and hopefully that will help you out. I am going to pass it off to
share really quick. There are some tricks if you work for a nonprofit, and if you make two payments in a month, one on the 1st and one on the 15th or 16th, it counts as two payments. So if they say you have to make 90 consecutive payments, that's how you can double it up quickly and pay it off faster.
I had no idea. That is
and just
genius.
To give hope, or just to share, I was able to purchase a house with never making a single student loan payment, and I owe $80,000. And it just reflected as zero. Now things are different, but there are ways around it. Just because you have student debt doesn't mean that you can't get that credit line or get that home. It's just like you said, how it reflects on your credit report.
And so that's amazing. Thank you for that story, Mignona. It looks like Robin has also had some student loans forgiven. Awesome. Please do it. If just know they're out there. Debt tip from Tanisha. I like to divide my car payment by 12 and use the amount as the monthly principal only payment. Example, car loan note is $300. Divide that by 12, that's $25. So Tanisha pays $325. The key is making sure that they're making it go towards the principal, because loan agencies, loaners, they are going to make sure that they get as much interest from you as you can, but you have to dictate. If you are increasing your payments, go to principal. All right. Tanisha, it's all
I set it up online like that, but if you go online, they now have some options to do it, but I don't know if all places do it, but you do want to make sure it is just principal. So we're in our third week, and tonight's class we're going. And can everybody see my screen?
Yeah, it looks good.
Okay, perfect. Our agenda for tonight, we're going to be talking about our savings for goals, emergency savings, insurance. We'll also touch on investment and retirement as well. Okay, how do I prioritize on what I want to spend on? So for all of us, right? Sometimes the amount of stuff we have to spend money on can be pretty overwhelming. The financial plan it's coming in. Got that. So the financial plan that we will tackle in our last class kind of will help us sort that out. But today, let's just kind of think about some of the important spending categories that we already are committed to. And we'll also talk about some important categories which all money smart people should think about and invest in as well. So you remember how we talked about the debt snowball and the debt avalanche? We were just kind of watched that video on it. And so for the snowball, you're paying your smaller balances. And for avalanche, you're paying the higher interest rate. And those strategies, we kind of paid the minimum on the highest priority, like I was saying, and the minimum on everything else. So we'll kind of use that same concept when we think about how we pay into our savings, investments, and insurance. And the priority and the levels of the payments are really up to you and should just kind of be based on the values, your spending personality, like we discussed, and your money mindset. And so kind of think about that when you start to think about these categories and really what you want for your life in the long term when it is time to have to live off of this money. So some of the spending categories just off the top of your head that you can think of that are kind of common or that we should always include entertainment, going out to eat, debt reduction, our housing costs. Um, and I'm kind of taking out in these spending categories like the must-haves, right? Like the things that we have to actually think about or just have to pay, like housing, food, utilities, transportation, healthcare, and like basic living necessities. So for the security type of personality, what do you think their top three priorities would be? And you can put this in the chat. And actually, if you just when you're not thinking about your basic necessities, which of these are maybe priorities for you? And let's say like top three. And again, please feel free to share at any time or put it in the chat. I think somebody like a security purse type personality would probably really focus on insurance, savings, if there was any debt, getting that down to zero pretty quick, in contrast of like a free spirit or spontaneous personality, that person is probably going to have very different priorities on spending categories when we're not looking at basic necessities. They'd probably be looking at entertainment, ease of life, going out to eat, having fun and things like that with their friends and sharing in that financial blessing that they're giving out for people. And I just, there's no wrong or right. This just goes to what you value. And you'll have to kind of really think about that. In the last class, like we talked about this, it will just become part of your financial plan. So since we're kind of revisiting week one, let's kind of think back on what some of those long-term and short-term goals that you kind of thought of when you were thinking about your financial plan in regards to this class. And I want you to think about are the categories that you have now kind of serving that? We have in here a break room, but I don't think that our group is very big. So, our breakout room, maybe we can just use it, just stay together and talk about it in that way. And what we were going to do in the breakout was discuss one goal per person and how much that goal will kind of cost and how long it would be and what that goal will kind of look at. Does anybody remember their goals from first week, a short term and a long term goal?
Someone had braces. I remember that.
Oh,
I don't remember who though. I just remember I felt their pain.
yeah, braces are tough. I got mine at 32 and I didn't know what I was doing and it's not my best move, I will say that. Okay, so and no goals to share. Perfect. Well, let's kind of work on this example. I want to, let's say, take a trip to Mexico next summer. I know that the trip is going to cost me about $1,200. So when I'm looking at those categories and how I want to travel is like a top priority for me. So I like to try to save at least $100 a month to put aside for travel, just in general. But with this goal in mind, I could call this a short-term goal, pretty easy to break down and save $100 a month. I know this trip is going to cost me $1,200. Plan in advance and really prioritize that. Okay, emergency savings. How many people right now feel comfortable with their emergency savings? Put a 1 in the chat if you do, a 2 if you don't. So an emergency savings account is a crucial financial tool that's going to provide a safety net for any unexpected expenses or financial hardships. And it just will serve as a buffer where you might not necessarily have to rely on your credit cards or loans or, not being able to pay or bills or meet any of the other goals that you have in case you lose your job or you need your vehicle repairs can be really expensive, and the maintenance for that. Medical issues are a big reason to, like, you get sick, your job might not cover it or something like that. Or just even as an entrepreneur, how many of you right now feel comfortable with if you got sick, you'd be able to live off of what you have saved now? I definitely don't feel like I could be sick for more than 30 days before it started to look pretty bleak. Home repairs and things like that are good for emergency savings. So how much do you need for your emergency savings? Does anybody know how much they would need for about 3 months of emergency savings? Have you sat down? Have you calculated it? And this is kind of just like a best guess scenario. Experts will say, and I've always kind of heard this rule of thumb, if you're a renter, you should have about 3 to 6 months of an emergency savings fund, and homeowners should have about 6 to 9 months. I think that that's a great goal. It might not be very realistic for everyone. That's a lot of money to just kind of have, and it's something that you would be building up over time, right? Things like job volatility, family sizes, rent going up, your mortgage, anything related, any health issues can really affect how much you might need to save and what that might look like for you. So me as a single mother with 2 kids, I might have to save more as an emergency saving than somebody that was a single person that did not have anybody else but themselves. Um, but you also might need as much if you have someone else. You might not need as much as if you have more resources, maybe family, friends, a community that you can lean on, move in with. If you don't have a car note, you take the bus to work or a bike or something like that. It can really fluctuate. So, Suzanne, as a homeowner for as long as you've been, what do you feel comfortable with as an emergency savings?
So, I've kind of learned my lesson with this. And I actually try to keep $30,000 in cash available for emergency. I know that sounds like a lot of money. But we have had times when we needed to actually use that. Especially when jobs are insecure. So like right now, we don't know what jobs are going to be looking like. And so having that is going to help us, be able to pay our bills for 3 months. We have a big family too.
Yeah. Does anybody else feel comfortable sharing how much they feel like they need for an emergency savings?
I would say 6 to 9 months. I had it at one point. I don't have it now because I'm starting a small business right now. But my goal is to just be, after I get my business going, to just have my car and my house debt. And so if I just have that, then I can do the savings. So I'm trying to get all my credit card debt cleared up.
Thank you for sharing that, Robin. And even just with all of that being said, $500 cushion could be really helpful, right? Just anything that
That's a
you can put
lifesaver.
aside. It can really mean the difference between, like, your electric staying on, your car needing something. So whatever you can put aside for savings, do something. And I know, like, it can be hard at times. I remember always being told, oh, pay your debt off before you save. And that's such a backwards kind of way of thinking, like, sure, pay your debt off, but always try to make it a priority to save some amount of money for yourself, even if it's just $25 a month when and where you can. Okay, so why is insurance important, right? So insurance, one of the number one reasons we've hoped for it to be important for us, and maybe not one, just top few, right, is financial protection. Insurance is supposed to help mitigate the financial impact of unexpected events like car accidents, illnesses, natural disasters. There's all kinds of insurances out there. And at this point, I always go into getting insurance thinking that this is going to save me in the long run and kind of give me a sense of peace of mind. Um, we also, it kind of provides that safety net, right? It's also risk management. Insurance allows us or individuals and businesses to transfer the risk of potential loss into the insurance company. It helps kind of protect us from that financial burden of a large, unforeseen, unexpected expense. And again, the peace of mind, knowing that the insurance is going to cover it, and that does help reduce the anxiety and the stress of, gosh, I just got in a car accident. I don't have insurance. How much is this going to cost me? What else will I lose? Because it'll be more things with that too. Also, legal requirements, right? Certain types of insurance, such as auto, are legally required in most jurisdictions. And lender requirements for some large purchases, lenders will often require insurance coverage to protect their interests, like a home, a car, or a business. MESO does offer insurance classes specifically for small business owners that go into a lot more detail. So if you need more information about those classes or you're interested, you can always talk to Suzanne. Okay, a few types of insurance that we have. So insurance is like a contract that provides financial protection against the specific risk or loss that you have that insurance for. So in exchange for the regular payments, which we know as premiums, the insurance company agrees to compensate any losses that you have because you're insured. So auto insurance, this is required in most states. Like I said, it's going to pay for the damages to your car and the other car and the other person's car if you're in an accident, depending on whose fault it is. Health insurance required by law. If you don't have it, you will be penalized on your taxes. Homeowners insurance is another one. This can help pay for any damages to your house and your belongings if there's fire, theft, or other events. Also, if you buy a house, some mortgages will require mortgage insurance, and that's after you get to, is this after you've paid off, is it 20% of your loan, I believe? What is it when you don't have to carry the mortgage insurance anymore?
20% is accurate.
Yeah, that's what I thought. Okay. So after you've paid off 20%, you don't have to carry the mortgage insurance anymore. But before then, it's usually a requirement. And I highly recommend you meet with HUD housing counselor if you're going to be purchasing. They can help you with all of that as well. Renter's insurance is super similar to homeowner's insurance, but it's just for people who rent. It's pretty cheap and can be bundled on with your car insurance. Most of the time, they will offer it to you. And obviously, I highly recommend it. It's a really good thing to have renter's insurance, especially I think you can usually get it for $12, usually less than 20. And then life insurance, which can help provide, financial support for you and your family. Well, mostly for your family after you've died. So there's also all kind of new insurances. What is a new insurance that you've recently come across that maybe is out there in a way that, like, I know travel insurance is another new one that I feel like when you go to buy a plane ticket or do anything, there's so many levels of like, do you want to insure this part of the trip? Do you want to insure this part of the trip? The flight, all the things. Funeral insurance, natural disaster like earthquake insurance is usually not included. Also, nor is flood insurance, usually not included in just your average home insurance. So you'll have to ask for it or at least bring it up to find out about it. Liability insurance is also something to consider, especially for homeowners. Are there any other insurances that people are using that we didn't talk about or is not listed up here? And you can put it in the chat.
I was gonna say, for me, when I had my health emergency, I learned about disability insurance. So when you are ill or you're not able to work, you're still paying into this insurance policy that will pay when you can't work anymore. And that was something for me that was very new because I had to use my savings. And I was in the hospital and I said, well, gosh, I can't work now. I have to use my savings. And my nurse said, well, that's good if you have some. But to me, I'm like,
Yeah.
that's the priority is to focus on the savings. And I know what it's like when you have to use it. And I wish I would have knew about the disability insurance sooner. But that was something that was different to me. And they came around to our job. I worked for the post office and they would offer that to us. But I'm definitely an advocate for insurance, anything to make those provisions.
Yeah.
Absolutely. Yeah, and I feel like there is just insurance for so many things now.
There's some, I don't know if you're able to see the chat or not, but let me tell you
I
what's
can't.
in there. So Elisa just mentioned the disability insurance. Celine says pet insurance.
Yeah.
Rebecca says health insurance for your pet also. I have malpractice insurance for therapy business.
Yeah.
Mignana says travel health care insurance or travel insurance also.
Yes.
Absolutely. And business insurance. The business insurance is sort of a separate bundle from what we're looking at here because we're just talking about your personal insurance. But sometimes you can bundle your business stuff with your personal stuff and then you reduce pricing if you do that.
It's perfect. Okay. So, how to reduce your rates and bundle and save. So, we hear about bundle and save quite a bit. And it seems like I'm 42 and bundle and save, I feel like is a phenomenon of the last like 5 to 10 years where it's with everything now. Um, who can tell me kind of what that means? Does everybody understand what it means when I say bundle and save? And you can just do a thumbs up if you do know or one in the chat. But basically, when you combine several things together, like your auto, home, life insurance with one carrier, they're going to give you a discount for bundling the insurances together. Uh, Another question, of the people that carry auto insurance, how long have you been with the same insurance company? If it's been for more than 1 year, will you give me a thumbs up or throw a one in the chat? You've been with the same company for more than 1 year?
Yeah, you've got ones in the chat, Celine, Monet, Robin, more than 1 year.
Okay, so shopping around really is like no joke. Many people, like we all and I am very guilty of this. I kind of stick with it and I go with it. I used to carry USAA, everybody, and most places it's like really great to have it. It'd usually be really noticeably less expensive than other carriers. Oregon, Portland particularly, that is not the case. And I remember when I first moved here from Salt Lake City, like even the insurance lady was like, "Whoa, this is a big jump." And I started to shop around. So shopping around can give you different rates. I remember when I bought my home, again, USAA, I went to go get home insurance. It was considerably more than going with who did I go with? Who do I have? Maybe Allstate or something like that. But shopping around is going to be one of the best things you can do to get the best rates and checking in often. We get comfortable with a company and we just stay with them. And it's very easy to do that because, again, it's just like another thing on the list. And the minute you look for a quote, you're going to get emails from every insurance company within a 10-mile radius, for like 20 days. And it does suck. But by shopping around, you can significantly reduce premiums and increase coverage. And when you do shop around, you like kind of compare, you'll be able to compare these deals, right? Comparing apples to apples. Get multiple quotes, consider the deductible. Ask the agent how you can save. I recently added my son, and I am just now finding this out. If they get good grades, you can get a savings on that. If you get one of those little devices that follows them while they're, that's in the car, you can get a discount for that. There's a ton of things you can get a discount for. And it seems to like putting things on auto pay is another way to get a discount for things, which I don't know how much I like that, but it is what it is. Also, there's the, safety and security measures that will give you some incentives, and then reviewing your policy annually. Does anybody kind of review their policy, or do you just kind of go with what they tell you to go with, or the minimums? How do you feel about your deductibles right now?
I like my healthcare deductible because I've already paid like the entire amount. So now pretty much everything I do is free.
I'm always
I
mad
don't
at this.
recommend it.
That's not bad. Okay, so also another thing for rates, did you know that they also look at your credit when it comes time to get insurance? So having a good credit score, the feds allow companies to look at credit reports, insurance credit score. It's not the same as your FICO, but it is similar. Being credit invisible, which remember, credit invisible is when you just like have no credit history. Usually this is teenagers and things like that where they don't have a lot going on. Does not impact the rates though.
I think there's one other thing with insurance, which is reading your policy is really important because you sort of think things are going to be covered, which may or may not. Examples might be if you have homeowners insurance, doesn't include flood, doesn't include earthquake. And if it doesn't, and those are things that you think are important, how do you make sure that's added? So my personal insurance did not have flood. It did not have, it absolutely did not have earthquake. I added it, and I had to find a company that would actually add it because not all companies will do earthquake. And same with flood, especially if you're in a flood zone at all. We actually had a main break and it literally flooded. I live right off Alberta Street. It literally flooded Alberta. There were like 3 feet of water on the street. It was the craziest thing ever. But if you didn't have flood insurance, there were people that had their basements flooded, their cars flooded. And so, kind of, even if you're not in a flood zone, you need to think about that. Also, that we have a class that we do on insurance that's specifically about business insurance, which Tanisha mentioned. We did just have it like last month. But if you guys are interested in knowing like a good broker, let me know because we do have referrals at MESO.
And
All right.
so it's break time. Do you want to do 7 minutes?
Okay.
And then
Go
come
ahead.
back at 6:50
Nice.
at
All
an
right.
even time?
We're going to
Okay.
do a quick early bio break and we'll see everybody at 6:50. And while I'm still here, number 273, I don't know who you are, and I don't know who Artydom is either. So if you want to let me know who you are, either in the chat or come off mute, let me know so I can count your attendance. All right. See you soon.
Hey, Suzanne, as we're coming back, I wanted to share something really quick. Yesterday, when we got out of our meeting, I was thinking because we do a lot of translations, and you were talking about, excuse me, Chat GPT. One of the issues is that our words in English don't translate over,
Yep.
like
Yep.
buffer. That was like an issue in one of our slides we were creating. So and I just looked it up in Chat GPT. That is an issue for accuracy when translating over because it's not an even one word doesn't replace another word.
Yeah.
So,
And it's even bigger than that. So for a while I was living in Poland, and when I was living in Poland, words that we use every day, things like membership, things like volunteerism,
oh yeah,
have completely different meanings. You can translate it, but it's not going to mean the same thing.
yeah,
Um,
yeah,
and it's like, okay, so you actually have to literally, you can't translate it. You have to interpret it. You have to be able
yeah,
to step
yeah.
further.
And then the
Yeah, I
nuance
agree
and
with
the
you.
styles. So I was just thinking about that last night. I was like, I got to tell her.
I
Thank
think we're on
you.
the same page. I agree
Yeah.
with you completely. Yeah. That's weird. Break time just came back up. Oh, okay.
Okay, this should be work. Perfect. You can see me and hear me, all right?
Yeah. Monet has a question. Just curious if anyone has gone through Costco for auto insurance.
I have not, but I've heard people say really good things about Costco. I mean, just for
Right?
everything in general, like that even I think I've heard that they have really good travel insurance apparently, and really good travel deals. I'm on like the travel
Mhm.
side of TikTok, and a lot of people talk about
Right.
Costco.
Car rentals are much cheaper with Costco.
Yeah, they
I
have
have heard
so
that.
many auto insurance. I mean, they have auto insurance, they have the disability insurance, the health, they have
Oh,
so
Wow.
much. But I was just kind of curious because I've never gone through it. So I'm like, hmm. So I don't know.
I've heard nothing but good things. I will say that. I've never heard anybody actually complain about the Costco like insurance. I didn't know they had all those other ones, but I did know about like the travel deals, the travel insurance, and people really promoting it. Try it. And I've also heard AAA is pretty good too. So I mean, I heard that they have a lot of like other things that kind of come along with it, a lot of other perks, but I've
Yeah.
not had them.
Yeah, I'm a big Costco fan, especially since when the whole anti-DEI thing came
Ugh.
out,
Yeah.
and their response was go away. And not only are we going to keep doing our DEI, we're going to double down. I was like, you go, Costco. Thank you so much for doing the right thing.
Right?
I actually just changed over my phone system to go with Costco. They had an AT&T style, and the thing that was best about it is I don't have to talk to AT&T. I get to talk to Costco if there's any like issue, and I've already used it.
Oh.
So I was like, okay, because I can't stand AT&T when it comes to their customer service.
Right. I hate to call, yeah, I definitely am not a fan of ever having to call Samsung.
Yeah.
I've reported them to the Better Business Bureau, and they were a lot more helpful after that. As a matter of fact, they were calling me. They were like, "Oh, hi, how can we
Interesting.
help you?" Yeah.
Hmm. Hmm.
Um, Anyways, okay, let me get us to the next slide. So, life insurance. How many people have life insurance right now? Do you throw one in the chat? Or is it a goal for anybody it's one of my goals. I don't have just like a life insurance that I pay into, but I would love to have it. Um, and what's your experience with it if you do have it and wouldn't mind sharing?
And actually, the question I would like to ask is, do you have whole life insurance or do you have term life insurance? And do you guys know the difference? Maybe I'll say that. The
And
difference is term life insurance, you're covered for a very specific period of time. You have it for 10 years. You pay the same amount every month for 10 years, and you're covered for the same amount. Whole life is often sold as an investment, where you're putting money into an account that you can borrow off of, that you can get returns on. They literally invest it for you. And in some cases, they actually have guaranteed rates of return. So Mignana has whole for self and kids, term and whole. Uh-huh. So this is one of those things that as I've been doing research on this, first of all, I want to say if you have whole life insurance, great, fabulous. It's probably pretty expensive. It is not the best investment option. Usually, what you'll hear financial educators say is get term, invest the rest. And the reason for that is there's a couple of things. When you have all this money that's accumulating, the that money does not go to your family when you die. What goes is like you have $1 million policy, the $1 million will go to your family, but the investment money does not. And the rate of return on your investment is much, much lower than even the bond market. So it's not necessarily the best way to increase your money. That being said, what happens with most people when it comes to investments is they don't do it. And whole life insurance is a great way to actually ensure that you are putting in money every single month. It is an easier way to at least get some investing done. But my feeling was I did the math, and that's what this slide has on it. It actually you would make more money if you just put your money in the U.S. stock market, even with the really cruddy term that we've had for the last quarter. Mignana. In order to get whole life, there are factors, background semi-checks, if you're a liability, health conditions, and affordability. Okay, Mignana, can you come off mute and tell me what that means?
So I had a DUI and it prevented me from getting whole life. And then they also do, yeah.
I didn't know that.
Yeah. And then, so there's like a length of time you have to wait. So you won't be able to get the best rate. And then your health conditions, depending on the insurance competitor or company is, it just might not be affordable.
Yeah.
And your age, of course.
I actually just today was talking to an insurance agent that does specifically small business. And we talked about whole life insurance because I knew we were having this class. And he said, tell them not to do it. If you haven't got whole life, don't get whole life. Go with term and put the rest in a 401k or whatever retirement they have. And the main reason for that is if you cash out your life insurance, you have to pay taxes on that. If you are putting money into a 401k, there are tax advantages to that, where if it's a Roth, you're not going to have to pay taxes. If it's a traditional IRA, you're going to be able to take money off how much money you're taxed on. And he's coming from the insurance industry. And so I was like, that's really interesting that he feels that passionately about whole life. But that being said, if you have a whole life already, that does not mean I want you to cancel out of that. That's a huge process. Like if you ever want to switch over from whole life to term or just get out of your whole life, you need to make sure that you do it right, because especially if you've only had it for a couple of years, whole life front loads all of the fees associated with it. And so you might want to consider waiting a few years before cashing out. If you get a loan, if you get a loan from your whole life insurance policy, just know there is interest charged on that. So it's not like you're getting the money out. You still have to, it's like a loan, getting a loan from a bank.
I wanted to share. So this is the second time I've been in a position of purchasing or getting a home. And that was strictly why I got the life insurance. So it would cover the home in case something happened to me. So, but I appreciate
Absolutely.
the information that you shared. That's good to know.
So my husband and I, when we got term life insurance, we did exactly that. How long before we pay off our home? And we will have term for that period of time. So we did a couple of things that we considered. How long before we pay off our home? How long before our kids get out of college? And that was going to impact it. We still have term life insurance that we get now, but the amount that I have right now is significantly less than the amount I had 15 years ago when my kids were really little. Cool.
So I don't, does everybody understand the difference between the term and the whole life insurance? And you can just throw a thumbs up if you do, or one in the chat.
Got a thumbs up from Celine. Thank you, Celine.
Perfect. Okay. So what are just basic low-level investments that everyone can make, right? An emergency fund is a low-level investment. You can control it. I mean, cash under the mattress, a savings account, insurance to kind of like, just CYA, cover your butt, type thing. And then there is some like 401k or yeah, 401k, 403b, like for nonprofits. And then I'm not super familiar with this one, but the 457b, which is the state and local government. And then the TSP for feds and stuff like that, right? Those are some other kind of retirement savings that you can have. Retirement was originally conceived of like a three-pronged stool. And so when I say this, just think about kind of like a stool and how three legs are kind of propping it up, right? Where you have Social Security as one, and then personal savings as like another one, and then a pension, right? So there's kind of those three things we just previously named. And for most people, the pension is like not really an option anymore. Has anybody have a pension still? If you do, like throw ones up or
My husband has a pension. It's not very big, but he gets a pension because he works for the city.
yeah.
It's so rare. I certainly don't.
Yeah, because right now, like those have kind of been replaced with like employee sponsored IRA plans. But this means that you still probably need to have other savings in order to live at your current lifestyle of when you stop working. And right now, just thinking about the lifestyle that you want to have, do you feel like you are at a place where you know what that number looks like? You're working, you're making steps to get there. So you probably are going to have other savings and other investments, and all those things are going to funnel into these things, right? That we're going to kind of cover. And the things that will like affect your retirement savings, thinking about inflation and just thinking about a carton of eggs now and what that might look like when you're ready to retire, owning your home versus maybe renting a condo or buying a condo or something like that. And what is that going to look like? And do you have enough for that? And just with the way the stock market is now and all basically we know that life changes, right? There's ups and downs, and just having this cushion for later and all the things that will affect that cushion. Okay, so compound interest, right? How much you can earn. So compound interest is a concept in finance and investing that refers to the interest earned not only on the initial amount of money, so like the principal, but also the accumulated interest from previous periods and other like. So in other words, I guess it is interest on top of interest. Um, so with the rule of 72, it's kind of like an easy way to calculate approximately like how long it would take for you to double your money. Um, so thinking of it this way, right? If you invest $500 at 10% interest, the investment will double, right? So in 72, the 72 divided by 10 would be 7.2 years for that to double. Is anybody familiar with the rule of 72?
It's interesting. We teach this specifically because the powers that be believe that this is an important thing. I don't know why it's important. Like, who cares how quickly it takes your money to double? Um, but is it lets you think about your money as a big entity. So it's like, okay, so I think if I'm going to double my money, that just feels like something so good to do. Well, how long is it going to take you to do that? I think it's more important though to look at all of your investments, including your home. Yeah. So for me, rule of 72, people love it, but I'm like, whatever.
No, you're the word people familiar with. I'm sorry, I can't see the chat.
Uh, no, we're not. We don't have anyone on that.
No. Okay.
But I do want to say a little bit more about compound interest, because compound interest is the thing that tells you that the sooner you start investing, the better you're going to be. If you have not yet started investing, today is the day you need to start thinking about that, because it's never too late. But the sooner you do it, the better. The other thing is, and this is just me in community, just trying to say, if you know somebody that's getting their first job, they're just out of high school, they're just out of college, they're getting their first job, getting them to save as much as they can before they have kids and before they have, debt obligations that they're going to have to pay is really key. Because if you do that, if you start investing super early and you just set it and forget it, all of a sudden your dollar values become quite large. And this is, I say this from personal experience. Coming out of college, I didn't know squat about investing, but I started putting in the maximum matched amount into my 401k. And when I did that, I sort of just randomly picked an investment fund, and I set that, and that was a long time ago. I was in my early 20s. I did it for 5 years, and today, just that small amount of money that I did is worth $200,000. It's going to be a major chunk of my retirement investment just because I did it for 5 years when I was in my 20s. So think about compound interest and how positively it can impact, especially young people.
And then I guess a follow-up for that, Suzanne, how did you kind of calculate what you would need for retirement? Do you feel like
So
you're on track?
I'm 100% on track. Kevin and I, my husband and I, had a meeting with our retirement specialist, and we know that we're on track. My husband wants to retire early. I don't ever want to retire. I want to go until I'm 150. No, okay, I want to go until I'm 90. Okay, whatever. But he wants to retire at 60, and we had to look in to see if that was going to be possible. My husband and I learned the term super saver when we met with the guy, because apparently my husband and I are both really good super savers. And because we're super savers, we have been able to put aside enough money, even without using our home equity, to be able to retire at the level that we're currently spending. That's the key piece is, anybody can retire at any time, but how comfortable do you want to be? And I'm a traveler and I know it's expensive. So I needed to be able to have enough money to be able to do that in my older age. So yes, I'm a huge advocate for saving for retirement. Huge, huge advocate.
Perfect. Thank you. So we're going to look at investing as a way of saving for retirement and generational wealth. And just a few things, even just looking at this, right? We're going to look at these pre-tax employer-sponsored retirements versus the post-tax employee-sponsored one. But also knowing that many investments can go towards like living expenses, paying for other investment options, or even just kind of paying down debt. As small business owners, you can purchase these retirement options for you and your employees. It's called a simple IRA, where employees can contribute, and then SEP IRA, sorry, RIA, where only yeah, I know, right? Where only the employer can contribute. So just think of the 401k as for corporations, a 403b is for nonprofits, and then the 457 is for government. And you can see those on the list, right? So those are post-tax employee-sponsored ones. In many cases, these retirement options have like match contributions. Most of you have some type of experience with, and you can just throw a thumbs up or one in the chat with having a job where the employer matched some of your or a percentage of it. And it's usually anywhere from 3 to 5%. So if you put in 3% of your salary, your employer will match that 3%. Okay, so here's just the number one piece of advice. If you're not already contributing to your employer's matched retirement fund, do it. Do it and do it. If you're in a position, do it to the max. Take full advantage of the fact that somebody is matching some of that with you. Almost all employers' matched funds go into a traditional IRA because they are looking to get the tax benefits. But if you have a company that is going to match that, take full advantage of it. Does anybody have any of these retirement accounts already or at any point?
Is anyone out there not involved in their company's 401k or retirement plan that has a match? And it's possible you're not even.
Go Urkel has one, but it didn't look good to me.
Why?
I don't know. I don't know. Well, I also, my second job is through Multnomah County as a personal support worker. So I went with that option, and I just didn't want money just flying out left and right. So I just focus on one right now until I better understand it. Just like with the W-4, like, do I need to claim 2 over here and 2 over there? And so I just decided that this year would be the year that I would focus more on my investments.
That's smart.
So
just focusing.
I get that. It is hard to keep track of it, but if ERCO is actually putting a match in, you're giving up money. So if it actually makes more sense if you can't afford it because you're already putting money into your Multnomah County one, that makes sense. But if you're not taking advantage of that match, you're literally leaving money on the table. So my advice would be to max out the matched piece in both organizations. It's like giving yourself a 3% raise. And with compound interest, that makes a huge difference. And you're still really young. So, by the time you retire, those accounts will get very large.
I'm on it. Thank you.
Thank you.
She said, you're going to do both today. You're going to get this money. Okay.
Yeah, go Rebecca.
Yeah, I've got a question. In my IRA that I have, maybe this may seem like a silly question, but there's all these options as far as different companies that you can invest them into. I have no idea what that is, and I have no idea which ones are better for what.
And that is the difficult thing. And they'll give you this book that's like this big, and you're supposed to figure out what all this stuff means. And it's I have no idea. I can tell you the rule of thumb that I use. I look for funds that historically have done well. So I just look at what's their percent return that they've had for the past 10 years. Then I look at which ones have high fees, because sometimes they have higher fees and they're kind of hidden and you don't necessarily know it. So you can just look at what are their fees, because they're going to tell you that. And then the other thing for me, which I have now done, I used to be much more playful with it and have a bunch of different funds that I looked at. I use what's called an index fund. An index fund is a way that a company, a brokerage is trying to match the U.S. stock market. They're not trying to necessarily do better. They're not trying to do worse. They're just trying to match it. So it's a very diverse set of stocks. I personally use what's called a target date index fund. And the target date is the date that I am going to retire. As I get closer and closer to approaching that retirement age, the calculation of how conservative and how the balance of stocks to bonds is going to become more conservative as I get closer to that time when I'm going to be wanting to take it away. So my advice is literally just look at which company. Often you don't have a lot of choices of which company to go with. Your organization is going to tell you which company to go with. But just look at the index funds and see. It used to be mutual funds was the thing, but the thing with mutual funds is they had really high fees. So at this point, I have everything pulled over into index funds. I let them do the figuring out. So that's actually a really good question, Rebecca, because I think that's one of the biggest fears that people have when it comes to opening up their 401k is it's daunting. You just have no idea what you're supposed to do, right?
So then we're going to touch on Roth
IRA.
IRAs. I don't know why this is so hard for me right now. And then traditional IRAs. So the employer sponsored Roth IRAs are paid from your paycheck after you pay your taxes, right? So you have access to the funds after the age of 59 and a half, where you will not be charged tax on any of the gains. The Roth IRA can be used before 59 and a half with no penalties, but you will have to pay taxes on the gains. So there is like a kind of a carve out. If you're a qualified first time home buyer who hasn't owned a home in the last 3 years prior to closing, right? I know that was a lot to kind of follow. You can withdraw up to 10,000 to buy or build your first home without a 10% tax penalty. So some qualifications, only people making like less than 144,000 K or couples making less than 214,000 are eligible. And then the maximum Roth IRA contribution is 22,500 unless you're over 50, at which point you can do 30K. So there are no minimum distributions, though, unlike a traditional IRA. Does everybody kind of already know what an IRA is or the differences between it? And you can throw a thumbs up if you do kind of know or have some idea with it, or one in the chat. So traditional IRAs are taken out of your paycheck pre-tax, which means your tax bill will be lower. Sorry. Okay. So the maximum you can put into a traditional IRA is 7K and 7,000 and 8,000 if you're over 50. And when you take the money out after the age of 59 and a half, you'll have to pay income taxes on it. If you withdraw the money before the 59 and a half, you'll have to pay penalties unless it's less than 10,000 and you're using it for the first time homeownership or higher education. Is everybody kind of following me with it? I know it's like a lot of kind of stuff. Okay. So once you turn 72, you will need to take out a certain amount of your IRA that will change over time, but based on how much you have in, but it's based on how much you have in the IRA. So if you believe your tax bracket will be like lower when you retire than it is now, a traditional IRA would be good for you. But here's like kind of another hint with that. When you start taking money out of your traditional IRA, or I'm sorry, let me say this. When you start taking money out of the traditional IRA first, as this will allow you to kind of allow your investments to earn money for you tax free, and you won't come across the potential that your taxes will be higher with your minimum requirement withdrawal. So is that making sense, everybody? Okay, perfect. So this can be like a bit confusing, but the maximum you can contribute from your paycheck is a total of the 22,500 combined Roth and traditional, right? So the max you can take out of a non-employment IRA, whether it's a Roth or a traditional or any combination of these, is 7,000 unless you're over 50, at which point it's the 8,000 again. Bottom line, I know it's a lot. And two, have you called who's carrying these for you and just asked to talk to somebody and get some of those questions? That's always a good step. They do want to help you, and there are people there that can answer your questions if you want to know more specifically about your IRAs. But bottom line, both are great options to help you reduce your taxes. Traditional IRA, you reduce your taxes now. Roth, you reduce your taxes later. So don't worry about like choosing the wrong one. Having a mix is great. Having just one is even better too, right? Are there any questions about that? Wait, what'd you say?
We'll talk about this just a little bit more as well with some examples in just a little bit. Frantice, you asked a question about, does MESO have like financial people that can help? Not really. I know a lot about this. If you wanted to give me a call, I'm not a financial planner. That's not what I do for a living, but I'm pretty good at like pointing people in the right direction or translating what it is that actual like professionals are trying to tell you, because it's very confusing.
Yeah. Yeah.
Yes, Celine. Any advice on combining IRAs from previous jobs into one? It sounds so daunting. I have had so many jobs. I've got IRAs kind of all over the place. My husband, though, 2 years ago, started pulling all of his together into one location. There's paperwork that you have to do. It's not that complicated. Some of it you can actually do online, but just realize you just have to do it. It's not difficult to do. If you have an IRA that was a Roth IRA in one company, they will roll it over into a Roth IRA in the other company. You don't have to do that, but I actually will be doing that this year as well. I will be putting, because it's complicated to know where everything is. And you got $2,000 over here and you got $5,000 over there. It's like you want to put it all together and figure out if you can actually retire. So when my husband and I did do this, like talk with a financial planner about our retirement, for him, it was easy because he had it all just right there. For me, I had to go in and find all of these little things and how much they were worth. So I recommend putting them into one place. It is simpler than it sounds. Thank you. Yes. All right. All right, Frantice, I'll look forward to that. All right, this is a picture that I want to show you, because remember when I mentioned about telling your 21-year-old to do what they can to save while they don't have that many overhead expenses? This is my son's retirement. He called me late last year and said, "Hey, Mom, this job I have has a 401k." I'm like, that is great news, fabulous news. How much money do I put into it? And I said, "Well, how much money can you put into it?" And he said, "I don't know. Should I put in the match?" I'm like, "Yes, you 100% should put in the match. If you can put 20% of your check in right now, it will go a long way towards your future." So he started doing that. And you can see if he continues at this rate, when he retires, he will have $4.2 million. That's something that you can easily retire on, and you are creating intergenerational wealth because his kids are going to get the benefit of that investment that he's making now as a 21-year-old. I did want to point out, I asked him about his retirement to give me his latest, because this was from earlier on. And he's still putting that down. The interesting thing is, because the stock market has not been doing particularly well, in this last quarter, something happened in the last quarter, January sometime, some major world changed the stock market not for the good. And so his investments have actually gone down. But my advice is usually look for the long term. Yes, your investments are going to go up and down. There is no guarantee that you're going to be making money. But if you go for the long term, it will make more sense. And I'm going to actually show you in the next 2 slides what I mean by that. Wait, no, we'll do this. Is that the next slide after that, the investment options?
What the heck?
That's okay. That's okay. We can do that.
But wait a minute. No, I know I changed it. Oh, it's after this.
Yeah, it's after this. So, okay, hold that note. We'll get back to there. Do you want to do this piece?
Good. You can go ahead.
This is actually relatively easy to understand. You hear stocks and bonds, and what's the difference between your stocks and your bonds? With a bond, basically, you're giving a loan to a company, and they're going to guarantee that they're going to be paying you that money back with interest. There tend to be pretty low interest in the 4% range, not very high. It does vary. They're very conservative, and you are still not guaranteed that you're going to get this return. But historically in the United States, if you are investing in bonds, that's a very, very safe thing to do. it's like I said, when I have my index fund, that's a target date index fund, it is going to have more bonds as I get closer and less stock. Additionally, with that investment piece, depending on how like aggressive your funding is, sometimes you can get really high rates of return, like we're talking, 15%, and sometimes it's lower. So bonds, more conservative, good idea to have at least some of them to balance out your portfolio. The index funds is what I specifically mentioned earlier. And it is a collection of stocks and bonds. It is a lower risk because they're just trying to match the stock market. There was a study that was done a while ago. It was this kind of a big joke of, hey, if we had monkeys pushing buttons to decide what to invest in versus professionals, who's going to do better? And they both basically did exactly the same. So for me, the index fund makes so much sense because you're just pushing it, everybody's collecting all their money together and they're going to buy a little bit of every type of stock. Well, it's not exactly true, but it's going to give you such a large swath of choices that you just match the stock market. And there's that target date fund that I mentioned earlier. So let's go to the next slide.
Okay, perfect.
I wanted to show you this. This is actually mine from the end of last year. This is just my MESO account. You will see that I was putting 1% into a traditional IRA and 25% into a Roth IRA. As I approach retirement, I want to make sure I have enough money in there to retire. And I wanted to get the largest tax break that I could get. There is a possibility that I will be making more money in retirement, at which point it's questionable. I do have a mix of both traditional and Roth IRAs. The other thing that I wanted to show you with this was last year. And it was a year, see the performance where it says it went up 14%. That was a really good year. 14% is a very high rate of return. Okay, now let's go to the next one. I literally just pulled this one. So you can see I have more money in there, but that's because I'm putting in 26% of my check. However, this is something I want you guys to do because I messed up on this and I don't want you guys to mess up on this. My contributions are now 20% in Roth instead of 25% and 6% in that's the traditional IRA. I did this because I didn't know my organization only matched if I put money into a traditional IRA. They didn't make that clear. Your organization's probably doing the same thing. So if you are putting money into an IRA with a 401k, make sure that you really are getting that match. I just wasn't checking. And when I figured it out, I was like, oh my God, I'm only getting 1%. What did I do wrong? And then it was like, okay, I needed to change my contributions. To make this change, it took me 5 minutes. It is super easy to change what you're doing with your investments. Not difficult at all. The other thing I wanted to point out with this slide was if you look at the performance, remember we were at 14%. Well, now we're at 9.71%. So the rate has dropped precipitously. When I asked my son to send me his was just for the last quarter. The last quarter, his stocks have actually dropped almost 10%. So it is not unusual for the stock market to go up and down. We are probably, at least this is what financial experts are telling me right now. It looks like we might be headed towards a recession. So it's possible the stocks are not going to be doing real great in that period of time. But if you have the long vision, and things will go better. The other piece that I wanted to point out here, because this is so important to your retirement, the thing that is going to cost you the most likely in your retirement is your health care. Right now, there is a movement to remove Medicaid from an option. Medicaid is for low income folks. And I think this is really going to affect people greatly in how they plan for their retirement. Right now, they are guessing my monthly retirement funds are going to be $786 per month. That's just me personally, not me and my husband. My MESO, if I continue saving like this and I work for another 7 years, I will be making $1,600 a month just from MESO. That does not include all the other IRAs that I have. So balancing that, what's my health care going to be with how much money am I bringing in? As you get closer to retirement, you're going to want to do that calculation just to make sure you're on track. Just telling you right now that if you start now, you're going to be a lot more comfortable when you're 60 like me. Okay, very cool. Thank you. Okay. So here we go. How much and how do you do it? This kind of goes to Rebecca's question. Again, number one thing right now, if you are currently working for an organization that has a match and you are not getting that match, do it tomorrow. Get that match. Start making that extra 3%. 3% is like usually the minimum. I've seen it go up to 5%, but that gets to be a pretty big chunk of money over time. Thank you, Bonet. Automate it. If you make it so that it's coming out and you don't have to think about it, basically, if the money's coming out and you don't see it in your paycheck, you don't have that money. So you're not going to feel like you're losing money because you're going to be able to live off of the amount of money that you're pulling in. So if you automate it so that it's coming out without thinking about it, you're much more likely to save. Yeah, out of sight, out of mind. That's that concept of if it's not there, you're not going to miss it. When I was creating this slideshow, I happened to be in New Mexico at the time. I was staying with my mother-in-law. My mother-in-law works for the New Mexican, the Albuquerque Department of Motor Vehicles. And well, at this point she's retired, but that's where she did work. And I asked her, I was like, so how have you been able to retire? Because you retired very well. How did you do that? And her response was, well, I started really small. I only started with like $5 per month that I was putting in. And then that bounced that up to $25 per month. And then I bounced that up. And then anytime I got a raise, I would put that money into my retirement. And so at this point, she is able to retire where, I mean, if she had not been that proactive, and she didn't start that until she was like in her 40s. So it is doable. You just kind of got to chip away out of it. So how do you do it? Okay. For those of you in this room that don't currently have an employer that is offering you a 401k, you can still invest. And how you would do that is you pick a company. I have some of the bigger ones listed there: Fidelity, Charles Schwab, Merrill Lynch. Also, you know what? Actually, Tanisha, maybe you can do this in the notes section of this slide.
I'm doing it.
Right. So one of the other things that I like to do is I like to sort of put my money where my values are. And so my 401k with my employer, I don't have a choice. They're going to tell me which company I go to. But there are opportunities to go to Black-owned brokerages, women-owned brokerages, Native, Hispanic. And if you are willing to do that, they're getting the same rates of return. They're doing just as well, but you're supporting a different community if you're doing that. So yeah, Tanisha's actually put that Bay Street Capital Holdings in. Elevest is a female run organization, and I personally have used Elevest. Okay, so what you do is you pick a company. We've given you a whole bunch of different choices. Which one you pick, you kind of get to decide yourself. You can interview them to see if they're the kind of people you like. You can do some research to see if they fit your values. And then you literally can go online and create this straight online. It is so easy to do. Hold on, go back just one minute.
Oh, okay. I thought I got all that.
Almost. You were close. So the paperwork that you're going to need to know things like what's your bank account number, and I again say automate it so that you have a certain amount coming out of your paycheck every single month. Since you are taking it out of your paycheck after you have received your paycheck, this is for people who don't have a 401k. This is just an investment that you're doing. Max out your Roth IRA at that point. So put those monies into your IRA. When you're doing your employer sponsored one, then you can decide between doing traditional and Roth IRA. But if you've already paid taxes, you might as well get the tax breaks that you're going to want to have anyway. So fill out the paperwork, tell them make sure you tell them to put it into a Roth IRA. You choose the investments, and this is what I was telling Rebecca, pick an index fund. If you want to go the extra mile and figure out which index fund is doing the best, go for that. Find the one with low fees and make that choice. And then set it up on a schedule. So you just set it up so that every month or every 2 weeks or however often you want, you're going to be taking money out of your checking account and it's going to go straight into your retirement. Here's one thing. If you are just looking to invest and you're not looking to invest for retirement, in other words, you just want to make money on the money that you have, absolutely you can do that. Just when you tell them what kind of account you want, don't make it a Roth IRA. Just go ahead and put it into a regular investment account. You will make money off that, and that is cash. You have access to that. When you take it out, though, you will have to pay taxes on the amount of money that investment has earned. Does that make sense? That's a lot of information. All right. Yes, next. Okay, so this is what, so if you guys are just doing stuff online, that's fine. If you have the opportunity to get a financial advisor, often if you have a work sponsored 401k, they're going to give you the opportunity to go and talk to somebody for free. Take it. Even if you don't listen to a thing they say, just take it, because the more information that you get from me, from other people, the better your understanding of this is going to be. The word I want you to look out for is fiduciary. You want to have somebody who is a fiduciary. A fiduciary must work for you. They have to do what is best for you. So you can just ask your advisor, are you a fiduciary? And if they say yes, then you feel much more comfortable about what it is that the information that they're giving you. Ask them, are they getting money on, how are they making their money? Do they just have a regular salary, or are they trying to sell me something so that they make money off my money? And that you want to look out for that, especially if it's a very high percentage that they're doing. Sometimes that's upfront. So they're like they would get a certain amount of money, compensation, like they'll get $5,000 if they get somebody brand new in. And sometimes it's like they're going to be continuing to get that amount over the time of the investment. Find out what certifications they have. Find out if the services they have make sense to you. If you are a small business owner, are these guys good at working with small business owners? Do they have the products that you personally want to have? And then I always like to ask them, what are the questions I should be asking you? What am I missing? Throw it back at them, because people will be surprised. They're like, oh, because they know they've done this with 100 people. They know what you should be asking. So if you ask them that, you're probably going to get better information. All right, next.
Okay. So diversifying, right? Diversifying your investments is such an essential strategy. Just like when we talked about with credit, right? Having a mix of different kind of credit accounts. It's essential strategy to like mitigate the risk, maximize any potential investment returns that you have. Of course, homeownership promotes wealth by building and acting as a forced savings mechanism. You are going to be saving, and that equity in your house is going to build up one way or another. So that is always a good tool to have. If you can do that, it's the number one way that most Americans build wealth. And wealth building really hinges on home ownership and the ability to build the equity in your home. And then, of course, a home provides safety. It's a tappable source of like income and value that can be passed down and that you yourself can use if you need to, right? And then real estate in general. If you are the kind of person that is in a position that you've got your home and now you can get some extra real estate, even better. That's owning properties that you can be rented out is such a tried and true thing. Like if you can rent out a room, if you could build an ADU, having that level of just kind of income coming in is always going to help you, right? It does take management and knowledge, right? But there's also all kind of ways to crowdfund and crowdsource money for investments like that. And then there's also firms. I don't know if you guys have heard of like Fundrise. I've seen them for quite a while, for a few years, kind of advertising, and it's like a bunch of people together investing on real estate properties. And then there's another one, Yield Street. Have you used them before, Suzanne? Do you use any of these? Have you ever? I've seen Fundrise, but I've never used it. And I've seen that it's been a while around for quite a while, so I'm assuming that it's really good. High yield savings accounts or CDs, which CD just stands for certificate of deposit, are ways to get slightly better than normal saving interest rates. Does anybody ever had a CD? You put a certain amount down, there's an interest amount that's going to gain, and then there's a time period. Usually, I think I don't know if you can do a
It
6 month, but I know
varies.
you can do
6 months
12
is sort
to,
of the minimum, right? But
yeah,
I mean, I've even seen
very
some that
low.
go in the years.
Yeah. Does anybody have any experience with CDs or high yield savings accounts?
Yeah, who's had a CD? And how
And you can
long
just
was
throw it in the chat if you've done it, used it. Did you find it to be beneficial? And then commodities, right? So commodities are things like precious metals, gas, farming products, or livestock, things like that. Um, yeah, CDs. I felt like CDs were really popular when I was younger, but I don't know if people are really heavily using them today, but they are out there and it's a really great way to say, I'm going to save this amount of money, get a little bit of interest on it, and not be able to touch it really before then. You can break it earlier, but there's going to be some penalties and some fees on it and stuff like that. But it's a really good savings tool. And then passive income, one last thing we always hear about it. It's always really kind of talked about is passive income. Things like peer-to-peer lending, renting that room, annuities, which are usually kind of like insurance based. Does anybody have an annuity? I don't think that we kind of push them in the way that we did maybe 20, 30, 50,
50 years ago?
50 years ago. Yeah, okay, I was being generous. You're right. Yeah, so they're usually like an insurance and based investment, often like used as retirement. Yeah, anybody using any of these things or have this level of diversification in their financial portfolio?
I don't have this level of diversity, but I do have diversification for sure. I actually am even looking to diversify a little bit more after teaching this class on commercial real estate a couple of times at MESO. My husband and I are seriously looking at purchasing a building right now as a way of having increased cash flow. And it grows with, it's going to get equity the same way a house will. I currently own one rental property, and this would be one thing to think about. If you guys currently own a home, great that you're living in, fabulous. If we do go into a recession and if we start to see interest rates dropping, which I'm not 100% confident that's going to happen, it's not a bad idea if you happen to have cash on hand to think about purchasing a rental home at that point. My husband and I did that in the 2008 downturn. And it was just sort of a lark. We were like, oh, interest rates are super low and house rates are going down. Why don't we just do this? And we did. And it turned out I was really skeptical. My husband pushed it. But now I'm so glad we did, because that house that we bought for, $190,000 is now worth, I think the last time I checked, it was $600,000. So just by purchasing a house and I haven't had to pay for that because my renters have paid for the mortgage. So pushing it, it's a little weird, because I think there's this mentality that we have, especially if you come from poverty. Like, my family was very, very poor. We never thought about the idea of building wealth. And so now this idea of, not only do I want to build wealth so that I can have a comfortable retirement, I want to build wealth so that my kids have a leg up, because that's the way things work in the United States. We provide money for our kids to have education, to have different learning experiences, to have travel experiences. And then the one thing I want to talk about with the CDs. So I currently have a CD. It has $1,000 in it, and it's a CD that's a year-long CD, but it'll just continue to renew. This is one of my emergency savings. Oh my gosh, if the world falls apart, I've got that $1,000. But at least I bank with On Point, and their high yield savings accounts right now, they call it a bundled savings account, is really good, much better than a CD, almost as good or about the same as a bond. So if you currently have a checking account, talk to your banker, find out if they have some of these high yield savings, because if they do, it's going to make a huge difference. Now, in order for me to get that, I had to have a credit card with that. I had to have automatic deposit, and I had to have a CD, or I had to have three things that were like other options of things to do. But now that I've done it, my entire emergency savings fund is in this high yield savings, and I am making money off of it. So I highly recommend it. All right. What was that you were showing? Was that?
Oh no, I was gonna get the rates for it, but I pulled up and I just thought I don't want to do
it might be too much work.
Yeah, it was a lot.
All
Social
right.
Security. You're gonna take Social Security? Okay,
I'm just gonna do the same thing I did last week. All right.
Okay.
You guys have not paid attention to anything yet? Okay. Yes, you have been paying attention. I'm sure you have. This is the piece you want to listen to. This is the piece that you are going to want to take home with you. You're probably at home already, but this is what you need to listen to. So, hello, everybody. Wake up. All right. Now you can take over.
Oh, okay. I'm here. Yeah, let's talk about it. Social Security, is anybody checking their Social Security, the website, and looking at their profile? And if you've set up, I think it's ssa.gov account, throw a thumbs up or one in the chat. Well, first of all, it's very easy to go check it. Just go to there, set up the account, then you can check your current eligibility. You become eligible after 10 years of making at least 1,360 per quarter, right? So in 2023, the maximum monthly payment was $3,822. The average payment is about 1,781 a month, but it kind of depends on your age, on what age you started taking the money. The earliest you can take that money is 62, but if you wait until you're 70, you will get a lot more within the month. And so, looking at the chart on the screen here, if I start taking benefits at 62, I can barely see that, sorry. It'll be, thank you, 1403. But if I wait until I'm 67, it would be the 2,282. And if I can wait until I'm 70, then I'll be able to get 3,036, right? That's an 8% increase per year. So it is worth it to wait if you can. Lastly, there's a lot of talk about Social Security kind of not being around for much longer. How many of you actually think that you'll be able to receive Social Security? Put a 1 in the chat if you think you will, a 2 if you won't. Social Security is a pay-as-you-go system, right? And so in the United States, we are getting older and having fewer children. So we are taking more out of it than we're putting in, right? That's just the reality of it. And we have until about 2035, which is kind of right around the corner. It doesn't seem like it, but it will go by pretty quickly. We have until 2035 to fix the problem. But if we don't, there are three things that could happen, right? We could have our benefits reduced by 20 to 25%, depending on, how old you are and what that looks like. We could increase the amount of money going into Social Security, or we could raise the retirement age like we did in 1983 when it was 65 and then it went to 67 for anyone born after like 1960. Has anybody, oh, I didn't check the chat.
Oh, Elise is already
right.
on SSDI. That's cool. How did you get that? Boy, that is so hard to get. I'm impressed.
It is. They are really bad about that.
And Monet has opened up. So this is your homework. Monet, you've already done your homework. Congratulations, you don't have homework. I want everyone in this class to go to ssa.gov and open up your account. Find out how much money you have, how much money you will be getting. It is eye-opening. It's also kind of interesting because it has like all the money that you've earned throughout your life. And in order for you to make a good plan going forward, you need to know how much money you're going to be getting. And who is it? Somebody in the chat made a really good point, which is about you may pass away before getting the money. That is correct, Robin. So this is the thing. Yes, if you wait until you are older, you will get more per month. However, the break even is 84. If you don't think you're going to live to 84, you might consider getting it earlier. And then the other thing would be is if you get it earlier, you can also take the money and invest it, at which point you're probably going to be making a higher percentage than the increase is. Because I think it comes out to like 8% per year that it goes up. Anyway, it is a big question. It's not a question you guys are going to have to worry about for a while because I don't think there are very many like 60 plus year olds in this class. There might be, I don't know. But when you start to add up, okay, if I wait and I'm going to be making $2,000 and, I'm going to add that to my retirement. And I know with that, I'm going to be making $3,000. Okay, that's $5,000 a month. Will that pay for my mortgage? If I still have a mortgage, is that going to pay, the things that I need to pay for? It's just a good idea to sort of figure out where you are and where you're going.
And it too has a lot of information on it. I always like the credit report. It does have like, if you ever need to go, oh, where was my job then? How much money did I make? Like there's a good kind of data info if you are filling out like applications and stuff and need it.
And there is one other thing. If you are married, so when you're married, you both get Social Security. If you have worked and you have to work like 10 years in order to be eligible. But you will both get Social Security, and every single month you will both get Social Security. If one of the spouses passes away, you only get the Social Security of the higher paid person. So if this person was making higher Social Security, may say they were making $3,000 a month and you're making $2,000 a month, you're going to go when this person passes away, you are then going to get that $3,000 a month. But the thing that's difficult to come to terms with is if you're married, you did have $5,000 a month. So you were going to go from $5,000 a month to $3,000 a month. So you have to think about, the plans of, one of you is going to die first. And that's going to take away a certain amount of money every single month from the money that you're going to be living off of.
This is yours, right, Suzanne?
No, I think that's you.
Oh,
it would be interesting to see if that's
I could
that
check
other
it out.
one. Just so you know, those numbers were mine, and I have not. There have been many, many years where I have not made a lot of money.
Yeah. Oh, so if I retire at 70, I will get this. I think this is probably about 2 years old too.
It is, and it would be interesting to check it, right? To go in and see what they say.
Maybe I could. I haven't logged out. So call to action, right? Okay, so I think we just lost somebody. Start investing if you haven't. find a financial advisor, log into your SSA account. Or if you are already with a company, call and get that free consultation or that free, the thing that's there, or see what they do offer you. They might even do one or two things, who knows? But check out what resources are already available to you, right? So, as you know, this is class 3. For next class, we are going to talk about income and expenses. Hopefully, everybody's going to leave with a good kind of budget or good financial plan and have a good overview of what their goals are and what they want to do. So, if you don't know how much you make or how much you pay for all your stuff, like kind of come together with maybe not so much, yeah, a budget. Come together with some things that you can help you make a financial plan. Are there any questions?
I want to ask a question. How many of you froze your credit reports?
Oh,
what? Oh, that's old. That's yeah.
never mind.
Yeah. All right. So seriously, I want to know if you guys did this because it's so important. I'm gonna nag you. I still plan on it. Celine, go for it. Please do this. Being a victim of ID theft is not fun. And I cannot tell you how many people I have seen where their lives have just gotten so difficult because they had to deal with this. Yeah, please freeze. And I'm going to be asking you next week if you have looked at your ssa.gov. It is fascinating. This one's fun, right? It's very fun.
Yeah, it's pretty basic. Let me try and log in.
It's so easy to do.
Yeah.
They are going to make sure it's you, which is good.
Yeah,
so
that's
they're going
the
to be
part.
the same way with your credit reports, where they're going to guarantee that it is you before they give this information out. They're going to ask some weird questions. Sometimes the questions are really bizarre, like what was your first, what street did you live on in such and such a date? Or, here are 3 street names. Which of these did you live on? I'm like, I have no idea the names of the streets when I was 22 years old. No clue.
They've kind of changed this up.
Yes,
and it's letting
Elisa.
me log in with my VA stuff.
So Elisa is completely correct. They have changed the process now for ssa.gov, where you create an ID Me account. And then once you do that, they can transfer it. So that's probably what you're seeing happening there, Tanisha. So the last time I checked ssa.gov was when they told me we're no longer doing it the old way. This is the new way we're going to do it. So
no, so the VA does the same thing. So you can it's login.gov. You can create a pass for that or ID Me. And I usually do the login.gov and I have it saved and it took it for this because that was not my original SSA login. But yeah, the ID Me is a really good one too. Like if you're a veteran, it'll save that status and you can use it like in stores for discounts and stuff and log in and stuff. Crazy.
Yeah. There's another thing about when you retire at 65, like I think it's within 6 months of your 65th birthday, you have to register so that you can get your Medicare and your Social Security. You don't have to necessarily take your Social Security at that point, but you do have to register. You're not going to remember this when you are 64 and a half years old, but just I've told you this time, and maybe in 10 years, somebody else will tell you again. You go, oh, yeah, I do have to register at some point, right? I literally asked a friend of mine just last month, when do you have to do that registration thing?
They were kind of going hard, too, I have to take a picture of the front and the back of my driver's license. They sent a link.
Wow. Okay. So maybe it's not as easy to get in as it used to. But once you've set up your account, right, Elisa?
It's
like
secure.
Now that you have your account, is it relatively easy to get in when you want to check your information? I'm assuming it is. It will log you into all government agencies, and yes, Elisa says it is easy once you've got that done. All right, you guys. Any other questions? This was a lot of information. Elisa does tell us it is simple. I agree. So much stuff. The investing piece is so much easier. Talk to your HR people. If you have not yet gotten your match, please talk to your HR people. I actually want them to change how we do 401ks. Right now, we have it as an opt-in system for most companies. And that's a barrier because people don't know what this means. It's confusing. You don't know what to read, and they're using like foreign languages, it feels like. And so I feel like it should be an opt-out system that when you get employed, you automatically get enrolled into the 401k. You automatically have that match taken out of your paycheck. We're not there yet, but I'm advocating for that. MESO actually now has an opt-out system, which I think is fabulous. Of course, they didn't tell you you had to do a traditional IRA instead of a Roth IRA.
Better.
All right, y'all. As you know, when you close out, there's going to be a little survey that pops up. And please fill that out for us. And we will see you guys next week. Thank you for coming.
Yes. Have a good night and happy early Juneteenth. See you
Happy
guys next
Juneteenth.
week.
Come to MESO's Juneteenth tomorrow. It's at the MESO Makers Market, which is right across the street from Old Town Pizza. It starts at 11, goes till 5. There's music, there's community, there's food, there's stuff to buy. So that's basically on the corner of MLK and Alberta, or MLK and Sumner, technically. So one block north of Alberta. Please join us. I'll be there. It's going to be fun. All right. Good night, y'all.
Good night.